So let's see if we get taken off. No. Okay. All right. Welcome back, everybody. Another Chart Addicts live stream. I got some pretty important things to share with you guys that I think everyone should take into account. There's some pretty big factors at play, and I think they're obviously just like everything else today. They're being hijacked for political purposes so that one side can throw stones at the other side and make themselves seem morally superior, be self-righteous. But I'm here to explain to you guys why there's actually pros and cons with Trump's new plan. And I actually think that in the long term, if we don't pull this off, uh, this plan could actually end up causing more harm than good. Okay. And that plan specifically is to keep interest rates low in order to stimulate the economy, in order to inflate away the debt. A lot of you guys don't know what that means. I'm going to explain this about as simply as I can before we get into tonight's stream. Before we kind of get into the markets, show you guys some of the trades I'm watching, some updates and market reports. And of course, there's a Fed meeting coming up on Wednesday, so we'll talk about that too. But there's something really important happening here. I watched not a documentary, but sort of a breakdown that Raoul Pal from Real Vision had done on the incoming retirement crisis. And I recommend everyone go watch that video because it has more information in depth. But long story short, we owe a lot of money to entitlement benefits and those, Social Security, Medicare, Medicaid, and some other things that are due, especially in the next 5 to 10 years. Now, as the interest on this debt continues to rise, because here's what happens. The government gets a bunch of money from taxes. Okay, so here's people, and then here's the government. And specifically, I'll put the Treasury here because that's the piggy bank of a country. Okay, so the money goes to the government. This is revenue. This is tax revenue. And then we go spend. This is the federal budget. Now, the budget's supposed to include things like defense. It's supposed to include infrastructure, entitlement benefits. It's supposed to include money to states, education, healthcare, border security, national security, and the rest. So what we've been doing is spending way more than what we're getting in. And because we have a lot of these entitlement benefits and the interest on those entitlement benefits continues to get higher and higher, the government will issue bonds and then sell those bonds, which is basically like people are loaning the government money. So the government goes out with their hat and says, give us money, and then we'll pay you back with interest later. So you have entitlement benefits, you have the budget, and you have the interest on this debt, which is the bonds that we're printing out of thin air. The government is financing this deficit, which is the fact that we're, spending way more than we're bringing in. This is called a budget deficit. If you're spending less and you have more money at the end of the month, you have a surplus, a budget surplus. If you guys are at your house and your home and you're doing a budget with your significant other or for yourself, and you realize that you can have a plan to make more money at the end of the month or have more left over than you spend, you have a budget surplus. Now, if you're spending more than you're bringing in, you have a budget deficit, not good. Typically, an individual will go to their credit card or some other type of debt in order to finance that difference. America does the same thing, or most governments do the same thing. But America is special because we can print our own currency, and that's the world's reserve currency. So long story short, we're printing money to finance the deficit, this difference. Now, when we print money, it's not like what most people think, which is you just create money out of thin air and now it exists and nothing happens. No, no. In order for them to get away with this scheme, they have to create tangible assets and then sell it to the Fed. Okay, so what they do is the Treasury creates bonds out of thin air. The Fed buys these bonds. Okay, well, the Fed first creates money out of thin air and then trades the Treasury for these bonds. So now the Fed holds a lot of debt over the government, and the Treasury now has a lot of cash that has just been printed out of thin air, but now owes the Fed this money back with interest. And so the federal funds rate that Jerome Powell is responsible for and the Federal Reserve is responsible for, this is going to determine how much we have to pay interest on these bonds and on the debt that the government is creating. And so the higher the interest rates, the higher the debt burden on the government. Does this make sense? High interest rates means we have to pay a shit ton of interest on the debt. Now, the interest on the debt is around $1 trillion a year. Okay. So I think we brought in something like $4 or $5 trillion of revenue this year, and the budget was about 6 trillion. There was a deficit of $2 trillion. That $2 trillion had to come from somewhere. Okay. Now, on top of that, a lot of this, like $1 trillion a year, is going to be by 2030. We will be spending more on the interest on the debt, just the interest, than what we be bringing in tax revenue. So if the government will bring in $6 or $7 trillion, the interest on the debt in 2030 will be higher than the money we bring in. So this is not about, this is like the interest on your credit card is more money than you bring in every single month. If your salary is 5 grand a month, your interest on your credit card, just to make it month to month, the minimum payment is more than 5 grand. This is making sense to you guys how fucked the current financial situation is as it relates to the government budget deficits and the interest rates. So what's the government's genius plan to get us out of $30 trillion of debt and then this, consistent deficit? We have two options. We either grow so much that the GDP of this country and that the tax revenue we're bringing in is so high that we're able to pay off this debt. Let's be honest, that's just not going to happen. The other option is look at these finance geniuses or these economists that sit in these rooms and just basically create this like giant diluted game that we all end up having to pay the consequences for. What they do is print a shit ton of money, print more. Okay, I'm gonna put a big word print right here, and inflate away the debt. I'm gonna have to write this out. Inflate the debt away. What does this mean? It means if I'm the government, and let's just say I'm going to use somebody in the chats here, James. I'm going to use James Seo here. James, if I owe you entitlement benefits at your retirement, let's say Social Security, which you've been paying every single month, they've been taken out of your check. Okay. And then there's a promise that when you retire, this money's going to come back to you so that you can keep the same standard of living in your retirement as you had before you retired. Okay. So they're going to try to match that salary. And so here's the thing. Let's say I owe you a total of $100,000, or let's just say $180,000, 90, whatever. And that's going to be over, let's just call it 17 years. Okay. Now, right now, this and every other account added up is a lot of money, more money than we can afford to give people. Now, what happens is we can either make so much money that this is not a problem, this and the millions of other people retiring, especially the baby boomers, is not an issue, or we can reduce the value of the currency so that this 190,000 is a lot less valuable to me. So for example, if I have $1 million, okay, and I have to give 19% of it away, that's a pretty big chunk, right? I'm not going to be able to really make that and the 50 other payments I have to make. Now, if I print a lot of money, let's just say I add a zero to this. All right, now I have $10 million. Now I still have to pay back $190,000 on paper. But now I can afford to do it because I just basically printed this money out of thin air and reduced the value of the dollar. Like this is how asset inflation works. This is how things get more expensive. Your house didn't get so much more expensive between 2019 and 2024 because your neighborhood got magically that much better. It was because they printed so much money that it just costs more dollars to buy the same unit of house. Does that make sense? This is what debasing the currency looks like. Inflation is nothing more than just the debasement of a currency by overprinting it and reducing its value so that you reduce you reduce the debt burden on you by making that, by making it easier to pay back those debts. Is this making sense to you guys? Just put something in the chats, put a 1 in the chat or something if you're following. This is basically it. This is all I got for you. But this is such a big deal that Trump's #1 plan is to keep interest rates as low as possible and then also boost GDP. Now, in turn, while doing that, there's also a lot of things about tariffs, which is Disrupting supply chains between us and our biggest partners and bringing manufacturing back to America is going to increase prices on a lot of goods. Now, at the same, so when you print a lot of money into the system, that's going to cause inflation. When you keep interest rates low, that's going to cause inflation. And then when there's a disruption in supply chains or supply chain partnerships, and then you're trying to bring manufacturing back to America while kicking out a lot of the immigrant labor, that is going to increase inflation as well. So then who wins and who loses in this situation? Same thing as, since 2020, the rich are going to get richer and the poor are going to get poorer. Here's what's going to happen. If you own assets, you get richer. Okay? Because if your house, if they're going to keep printing more of the currency, then your $500,000 house is then going to go to 600,000 and 700,000 and 800,000. This is the reason why a hamburger used to cost 25 cents, back in the 70s. And then now, the cheapest hamburger you can buy is probably what, $8, $10. It's not because hamburgers got 100 times better. And it's not because the world got less connected and supply chains got worse, because all those things got better and better and better. What happened was the value of the currency it loses its value every single year until there's nothing left. Okay? So if you own assets, you're going to get richer. This includes stocks, crypto, commodities, real estate, all of them. Now, if you don't own assets and you live on cash, which means you're basically just getting your salary, you're spending from it, the rest you have your bank account, you're going to be losing money. Inflation will hit the non-asset holders, and you guys will see this referred to as the have-nots. And then asset inflation will benefit asset owners in an exponential way. Because it's not going to be 1% growth, 1% growth, 1% growth. The more money they print, the worse the game gets, and the more it starts to speed up. And so the richer are going to get richer faster, and the poorer are going to get poorer faster. The reason this is an issue is because the country can't just allow 60% of the population to be non-productive, meaning that they cannot subsidize, we can't even afford to live. We can't afford to subsidize our daily life. The cost of going to work is now higher than the money that we're getting at work. That makes no sense. And so they're going to end up having to raise taxes to subsidize the portion of the population that we have not figured out how to integrate into this new model. So overprinting a shit ton of money to try to inflate away the debt and reduce our benefits, when those Social Security retirees, when the baby boomers, the folks that are going to be receiving these benefits, if they're going to get inflated money, if they're going to get debased money at the end with a market that's just very inflated, yes, they're going to get $4,000 or $5,000 a month, but now it's going to cost them $8,000 or $9,000 a month just to keep their lifestyle. So yeah, we might be able to make these commitments and pay this money off, but what are we paying these? What are we giving? What kind of retirement are we sending these people into, where the cost of living is so expensive that the money we're going to give them is not going to give them the standard of living? This is a crisis. So long story short, the doomsdayers are going to keep saying that the real crisis here is our inability to meet these retirement obligations. The real crisis is that we're going to inflate away the debt and that these people are going to get their money, but then they're going to be hit with such a shock of hyperinflation that there's going to be a secondary crisis, the real retirement crisis. And that's what we're going to have to subsidize by taxing the shit out of the citizenry in order to basically keep this game going. Okay? Now, every country is going to do this, and I think America will weather the storm longer than most people, but this is not a world that we want to accept. All right? And so I really hope that Trump and his team are taking this into account. And I think he has some very smart people around him, but they don't all agree. And that's the dangerous part. Listen, ladies and gentlemen, put something in the chats. We're all on the same page. This is big deal. Whether you're retiring or someone you love is retiring, you're going to have to foot that bill for them if they cannot afford to live month to month, if you actually care about your loved ones. If you don't care about them, then ignore this. And if you do care about them, then read up. Can you go over the EU sells for the week? The EU sells are officially done, people. Called this a long time ago. So we had the double top idea right here for Euro USD. And then lo and behold, the before and after is beautiful. This was from the live stream back September 8th. So over 3 months ago. And then the market finally dropped, hit that take profit. So for those of you guys in chart addicts, you guys can see it's a beautiful from top to bottom, 88.6, double top here. And then even on that live stream that I covered, if you guys want to go back and watch this live stream from the 8th, we talked about the double top correction and then the sell-off. So the first zone was TP1, then TP2 got smashed, and then TP3 eventually got hit 3 months later. Okay. Number one of the reasons. Yes, I'm trading because I understand that I may have to take care of my parents. Not might. I think that we should really think realistically about what the future looks like. Okay. How have I been? I've been doing great. I appreciate you asking. Am I going to do another NAS 100 masterclass? I've taken 2 of the classes. That's awesome. I personally will not do any more live masterclasses as of right now. We are launching a recorded version of the NASDAQ class so that people can have access to it in a much more compact way, easy to understand, all the important info, and just make it more accessible. But if we do a live element, I'm sure that we're going to have some of our successful students run those because they've clearly demonstrated they understand these concepts and their ability to you know, make use of those concepts to the fullest. All right, let's do a quick tour around the world. Actually, we'll do fundamentals, kind of walk you guys through the schedule for data releases, and then go through a tour around the world, show you what the currencies are doing and what I expect going into 2025. All right, best Econ 101 teacher. This was a little bit more advanced than Econ 101. Let's be honest. I'm disagreeing with some of the most important economists in the world that are saying that like every PhD economist at Stanford, at Harvard, at basically every liberal college is trying to figure out this convoluted delusion about how we can. They're like, oh, printing money got us in this problem where we have a runaway inflation, dragon, and we have to go catch this thing, and then we have to at the same time make sure the economy doesn't crash. And so they're playing this balancing act of slowing the economy down while speeding it up. And if you've ever driven with the gas and the brakes on at the same time, usually doesn't end up going too good, right? And so these guys are so deluded because they're fully invested. They spent the last 12 to 15 years writing a dissertation following some model that means that debt doesn't matter. This is what the modern monetary theorists, this is what they're called. Okay. MMT. This theory that debt is irrelevant, that the only thing that matters is the ratio between your debt and GDP. Because as long as you're making a lot of money, then you can always finance the debt. That doesn't mean you can pay it off. It means you can just make the minimum payment long enough to just keep living on debt. Now, if you guys know anybody that's living off their credit card and they're not planning on making any more money and getting out of this trap and this hamster wheel, they're only invested in making just enough more money that they can keep getting more debt and making the minimum payments and then rolling over that debt and rolling over that debt and finding more people to keep financing it. That is not how this is supposed to work. And so instead of figuring out a way to reduce costs, like reduce spending, which is what Elon and Vivek are aiming to do with the Doge Commission or the Doge Bureau, whatever they're going to call it, and then also increasing GDP. So bring in more money and spend less instead of doing the responsible stuff, right? What they want to do is overprint the shit out of this money to the point where paying off these other debts is very minimal and we devalue the shit out of the currency, but who cares? Because we own assets and those assets are going to go up in price. And so we're rich and we're going to make a lot more money. And screw that people and single parents and just even double parents who have a family are not going to be able to afford basic goods because they're living paycheck to paycheck and everything's just going to get more expensive year over year over year. That's a fucked up way to go about thinking about this. But that's why they live in a bubble. They live in a vacuum of hyper intellectual academia. And if you live in academia and you don't spend time in the real world, you get a Kamala Harris campaign where you keep convincing yourself that this is happening and data polls are showing this and what is it called? Focus groups are polling this and that. And then next thing you know, you get mollywopped by reality. Okay. Don't get mollywopped by reality, people. The undefeated super secret magnet indicator for the win. Can't beat it, can't touch it, can't fight it. Go ahead and, you know, roll it up, light it. I don't know. Look, let's go through the news real quick. Then we'll get to the charts. A very busy week for USD news. Early start to the week on Monday, December 16th. We have the usual Empire State Manufacturing, Flash Manufacturing, PMI, and Flash Services PMI. This is basically just a sentiment index for manufacturers, early indicator about what they're like the amount of orders that they're getting. And if they're having less, if the sentiment is getting worse, and this is generally you use like anything below 50 is typically not too positive of a sentiment, anything above 50. But again, always look at forecast versus the distance between those two. That's what causes the biggest market reaction, not necessarily the numbers themselves. But sentiment survey, early indicator of what they expect in terms of manufacturing and production. So core retail sales is coming out. This is a much more important metric. Retail sales and core retail sales excludes automobiles. The car market is too volatile. It skews the numbers and messes it up. And you usually buy certain goods less frequently than others. But retail sales is the underpinning of the entire US economy. If people are spending money, then everything falls into place. Corporate earnings, because they're getting money in, and then the stock price of those corporations, and then stock market performance leads to a lot more reinvestment, and then uh, this is just an overall like one of the most important metrics to watch. So retail sales, we're going to be seeing this coming in. And then, of course, Wednesday is the big shebang. We have the federal funds rate. Big Jerome Powell steps on stage for an estimated 25 basis point cut. So they're still cutting interest rates. I think that they're trying to, I don't know if Jerome Powell is trying to get on Trump's good side or what's really happening here. But inflation is technically under control now, according to their data. And so I don't really see the reason to start reducing interest rates at a time where we really do need to get inflation back down. And we have to keep it down for a sustained period of time. And then since Trump is coming back in, we don't even really need to lower interest rates to stimulate the economy. The growth in GDP, I think, is going to be enough and then the cutting spending with Doge, like Elon and Vivek, I think that's going to be enough to stimulate the economy. So I don't know why they're doing this. I think there's a political underpinning to this to maybe like have good numbers at the end of this administration so that it looks like they left Trump a great economy. Because on paper, it really does look like things are pretty good. But the real economy is not responding to that and making inflation worse. I just don't understand how that's going to be useful at all. I mean, shit. Anyways, so then we have the FOMC statement. Hopefully they ask Jerome Powell. I actually guarantee if there was like an over-under, whatever, like a DraftKings like sports book, if we could bet on this stuff, I bet you guys that some of those smart reporters in there that I always give a nod to, they're going to ask Jerome Powell about why the fuck he is dropping interest rates when inflation's already down and we already have an administration committed to cutting costs and then improving GDP. What the hell is about that? What was that about? Bank of Japan's doing the same, expecting no changes. Okay, they still have zero interest rates. This is an example of what could happen to America. This is the worst case scenario, by the way, which is a country that had to choose between going bankrupt and losing their bond market and not being able to pay back those debts, and then printing their currency so they can finance the bond market. And they decided to sacrifice the yen in order to save the bond market. And the Bank of Japan has been dealing with this slow decline of, this slow death of the yen because of this decision. And so if you don't get your spending under control and you allow the modern monetary theorists to hijack your country's economy, what happens is you'll have to make a choice between your bond market and your currency, and you can't sacrifice your bond market. That's what funds your government. That is your government at this point. Okay. If you're broke and you're not getting any taxes in, then the only way you can make money is by issuing bonds and finding some suckers like some other central banks to buy your shit, right? And so what Bank of Japan decided to do is overprint the yen to save the bond market. That's disastrous. They have a demographic decline at the same time. And so they're in a really tough spot. And we cannot end up in that same situation. Europe is next. Europe will go through this. Europe is on the way out. Mark my words, people. There will be more Brexits coming in the next 4 to 5 years as the European Union continues to play political games. While certain countries, I'm guessing Italy is going to be on that list of people that leave the European Union. I'm guessing who else? I don't expect France to do it. Maybe Belgium does. Like, we'll have to see. But the reason that Great Britain left is because the political decisions that the European Union was making was impacting the national security. So too much immigration and just sort of being too lax on policies. And then the spending that everybody was chipping in on stuff that was just losing money. And then these people were never going to recover, forcing everyone to keep the rates at the same levels and to have trade balances. And that sort of socialism bullshit is only ever going to stifle an economy's growth. And so Brexit happened as a way for the Great Britain to sort of have a chance of survival while Europe continued to dig itself in a grave. And now Europe's time has come. And hopefully we get to see Great Britain rebuild. They have to get their immigration policy under control. They have to get their spending under control, but they have a chance and expect to see a lot more separations there. We have final GDP for the quarter. This is for the third quarter, dropping on Thursday. This is really important stuff here. We got to see if the economy is still growing month over or quarter over quarter. But again, on paper, looks like Trump is getting handed a pretty decent situation. He just has to capitalize on the real shit, cutting the spending in the government and improving revenues. Core PCE price index. This is the real inflation measure that we should all be watching for. And it looks like there's still a month over month growth in inflation. That 0.2%. Not good. Inflation is still technically rearing its head up. So cutting rates doesn't make any fucking sense. I repeat. Okay, is it clear? We went through a lot of stuff here, but hopefully that made sense to you guys. I'm getting some questions here about BTC. Any live stream Uncle Ted ever again? He used to drop so much knowledge. Probably the best guest always. No. How about that? I'm not even gonna fuck. Why you guys do this to me, man? BTC USDT is at all-time highs. It hits 106,000. XRP about to blow up. XRP already blew up, man. XRP is through the fucking roof. Man, oh man. People will never understand how much sacrifice it took to do the FX Summit, selling all my crypto, and then, year over year, buying more crypto and trying to rebuild, and then having to gut it to finance the FX Summit, just to watch crypto absolutely rip, missing out on tens of millions of dollars. This shit hurts, people. But ego aside, and all that bitching aside, let's look at things objectively to figure out what the next opportunities are. Bitcoin's at $105,000. Now, could we have a second leg up? Whenever we see a massive bull run like this, and I'll have to take you guys back to some previous bull cycles to prove this point here. But at about 120K is going to be my target. 120K, 120K, 120K. Where are we looking at weekly? Okay. Markets typically move in twos. And so you'll have the first leg of a bullish move, and then you'll have the second leg, and then usually some kind of consolidation or correction. So when it comes to Bitcoin specifically, take a look at this. So we have this area of consolidation here. This is before the massive breakout in 2020. This is before the COVID printing extravaganza. You'll see this is really the first major leg of this move. Okay, this is where I made the majority of my money, and this is what allowed me to quit my job at Merrill Lynch and really walk away. I missed out on the second leg of this move. There's always a second leg. Then you have either a consolidation or a correction, and that's what we saw here. When the market starts to move aggressively, you'll have the first leg of the move. Everybody who's stupid enough to buy as the market is climbing always gets caught in what? The correction. So wait for the correction and try to buy at the lows. That's the big lesson here. Second leg. Okay, so first leg, second leg, then correction, correct? Even on the way down, first leg, correction, second leg. Then we have some kind of consolidation. Over here on the sell side, it was way less obvious. Okay, this was like a very, very sharp move, and it kind of always seems like the second move is always way more sharp and way more aggressive. Okay, so then we have this area of consolidation here. First move up, sideways. The second move again, look at the size of the candles. Way less of a slowdown, way less bullshit in between, way more of an aggressive pump. Then we have the correction. So then why do I say all this? Because what do we have here? First, so we have this consolidation here. First leg of the move. We had this minor consolidation right here. I'm expecting a second leg of this move. Typically, we have an A to B, C to D sort of path for crypto. And so what that means is in English, find this. Okay, so A to B, C to D. Oh, this is way too messy. How do I do this even better? Ooh, I got an idea. Because you guys know visuals is everything. Demonstration is key. I'm going to go here and try to find the beginning of this move, which really looks to be at the breakout. There was a fake back in. Okay, break above. I'm going to be very conservative here, actually. Go right there. Take this move. Place it at the new support. Okay. So this equal size move, A to B, C to D, means that these are going to be equal size moves in twos, which would put us up at about 130K. I'm willing to bet that we kind of make it a little bit higher, like 100 or a little bit lower, maybe 120. Another way to verify this, once you kind of have a clear idea of the area you're looking for, like that was more of like a general guess. When you really don't know what to look for, you kind of have to use these kind of age-old techniques. So for me, it's like if you look at, for example, this A to B, C to D move, you would expect the first, like these big impulsive legs to be the same size. So if I was to measure this from bottom to top, okay, and I was to drag this up, they're about the same size, aren't they? Right? So this to this, same size. Are you guys following this? All right, let's do this on the sell side. If I was to go from top to bottom here, and then I was to do the same thing, let me go top, we'll go bodies here. If I was to take this, copy and paste it, and then move it to the second leg of this move, would they be the same height? Let me remove this. About the same height. Okay, so that's where the A to B, C to D thing comes from. You can keep going. Like here's that leg that we saw before. And if I was to take this, copy and paste it, the start of that move to the top, I'm not going to make this any longer. I'm just going to straighten this out. Lengthwise, it's about the same length. Is this making sense, guys? Okay, so same thing would happen here. You would go first leg, oh wait, second leg. Again, would put us at about 130,000. All right, so that's first. That gives us a rough idea because once you're in all-time high territory, it becomes very difficult to sort of assume what's going to happen or to like find an area that you can. The whole point of trading or market analysis is to use historical data on the left to find some kind of reasonable high probability prediction of what's going to happen in the future. Now, when you don't have anything on the left and any data, historical data to anchor yourself on, you have to start using anchor points that are on the chart already. And so the equidistant move is the first one. The second one is Fibonacci. Fibonacci is a really good way to understand what the market does outside of a predictable range. So I'm going to use my extension levels here, the zero. So we'll have to go negative here. Negative 61, negative 88. I guess a pretty good area here. And then we'll just do negative 2. Nope. Negative 2. Or negative 1. That's what it should be. Okay. I think the negative 1, that'd be the new range. It's about 132. These are going to be reasonable distances. So when I'm measuring this fib, I basically just measured this Fibonacci from the bottom of this impulse to the top. What we have here is a correction to the 38.2 Fibonacci level. So this is already confirming that the market is respecting this fib sequence. Okay, if I was to adjust this, let me see if we get a few more touches. Nope, only gets worse from here. Don't get any better. Okay, few touch points. So we'll see if the market is respecting these zones. Let me do negative. Let me find a few of my key extension levels. And the more that the market respects those extension levels, the more that you can rest assured that it will respect the future extension levels. So you have to kind of use market confirmation as you go. All right. We have a beautiful wedge here. So this is the middle point. This is the middle point. So we have the first leg up. This is the gas station right here. We're going to have the second leg up. And then the same kind of size correction right here will probably either have a correction back down or it'll just stall out and play in this range for a long time. Make sense on this crypto stuff? Are we cool? What am I referring to with Doge? Doge is the Department of Government Efficiency. It's a new department that government Trump has signaled at starting, which is headed by Elon Musk and Vivek Ramaswamy. And the aim of that like new department is to cut wasteful spending in the government. And their aim is to try to find about $2 trillion of wasteful spending that they're going to try to eliminate, and then basically get this country back on track and make sure that the government stops wasting our tax money. Because we all slave every day, no matter what the weather is, no matter what time it is, no matter how we feel, no matter what, whose birthday it is or what we got to do, we all show up to work and we all slave our asses off. And then this money is just going to absolute fuck all, because of wasteful spending by these politicians. And so the Department of Government Efficiency's aim is to go in there and fix that once and for all and address it not through these committees like Rand Paul and by making these like sort of, these I don't know, demonstrative statements, but by actually going in there and shutting down whole departments, firing half of the government employees that just don't show up to work and are just wasting tax money. And then instead of just printing money all the time to like finance bad decisions, we actually get this country back on track through getting the spending back in control, which is awesome. Okay. So that's what I expect next. And then after that, I think we have a massive correction, which I think is very, very needed. If I go through and look at XRP, for example, XRP has just popped the fuck off. Excuse my language. Okay. Wow. Wow, wow, wow. XRP has exploded, people. We did a workshop in the DMV right here when the price was at 33 cents. It was me, Jason Stewart, the QB Stu. And was anybody at that workshop? Anybody here? That was on March 10th, 2023. And we were just talking about crypto and a bunch of other stuff. And $2.89. Holy shit. 716,000. For every 10,000 you put in, that'd have been 70 grand. Wow. Insanity. Um, damn, dude. This really hurts. I had so much XRP at one point. Okay, anyways. We're pretty close to all-time highs here. The all-time highs for XRP sitting at $3.30, which will give us a good 10x, 10x on the money. What a crazy, crazy ride. 10 to 1, incredible trades. All right. What else? Okay, let's go through the rest of these markets and then we'll call it a day. We'll talk about this more on the live streams tomorrow. Let's see what we can do. All right. So NASDAQ still ripping. All stocks are ripping, which, by the way, going back to the main point of this entire stream, Trump's tax plan is going to be great for asset holders. The markets will rip. That's why the markets are doing so well right now, is this expectation of this inflation crisis getting worse. Everybody wants to get into stocks. Everyone wants to get into risk assets, get out of cash, because cash is going to be even more trash than it usually was. It's going to be even more worthless. So if we get a full correction here on NASDAQ after this impulse, we make it back down to 21,450. If not, then this becomes our new range. Let me remove all the drawings. This becomes our new range if the market holds support here. Okay. Previous resistance. Then we had support go all the way through that zone. This is a Model 1 continuation for those of you guys who are interested. Draw your fit from top to bottom, Chart Addicts members. Okay. 71. I think it's 71. Nope, it was 78. All right. So 70 to 80, 70 to 90%. That whole range is the Model 1. And then Model 2 is going to be all the way down here at the 38 fib down here. And then we ended up having a retest. Let's get this going. Ended up having a retest. I think we could come back in for one more retest here of the 886. Okay, if we hold support, then that's going to be our new floor. Very, very simple stuff. I'm also seeing a correction coming in pretty soon, which is okay. We had the first leg of this move. Now we had this sideways action. I think that once we see the second leg and we push to the upside, we'll have this perfect three drive pattern right here. And that is when we'll see the correction come back down. So for now, there's two options. There's a deep retracement all the way back down to the support from last week, or there's a shallow retracement, which is just forming support exactly where we're at, waiting for that retest. And for members, come on. How easy can this get if it does come down? Because we have this perfect range right here. I have to move this just so we can see. You expect to move down to the 88.6. Okay, 88.6. So either we're going to hit the 88.6 on the top side first, and then we're going to drop. But I actually just feel like this double top right here would make a great area for a retracement, and then we can purchase this. We can buy up NAS tomorrow. To the extension levels. Okay, fair enough. Very straightforward stuff. There's going to be the trade there tomorrow morning, and then if it breaks through after, that's fine. But I think we'll be able to get at least a 3 to 1 on that trade, depending on our entry. Okay, so very straightforward. We'll go through the rest tomorrow on the live streams, give you guys something to look forward to. I'll show you guys the gold trade idea. Well, this is pretty easy. I'll be damned. Huh. Interesting stuff. Well, it don't get much easier than this. Move back to support, 26.23, and a push up. Why is gold pumping? All right. Why has gold been pumping since basically the election season? Because everyone knows cash is going to be trash and actually get into assets. Now, gold is not pumping as much as Bitcoin and stocks because I think the world has now recognized that gold cannot be moved around easily. Gold is hard to store and expensive to store. Gold is rarely accepted for anything. Like, when was the last time somebody offered you a piece of gold for literally anything? Right? And so I think that's becoming a less desirable asset. I think central banks and family offices and those sorts of folks with big like ties to banks and depository institutions, they can go leave their stuff there. But if all of us had to like get liquid and then to pay for an emergency, you can't use gold. And so that's why I feel like gold is just not going to be the highest performer, but it's still crushing. People waited so many years for this gold play to work out because they saw the inflation crisis getting worse and they made a gamble. This is like Peter Schiff, right? The Peter Schiff folks. That's the crowd, or Robert Kiyosaki's. Okay. Anyways, folks, catch you guys on the streams tomorrow. Happy and safe trading this week. Tons of news. And of course, make sure to hit the subscribe button, check out our website, and check out the link in the description for FX Summit 2025 in Latin America. Catch you guys later. Take it easy. Peace.